Finanzkrise wurden häufig Dichtung und Wahrheit miteinander verknüpft. Häufig wurden aus Meinungen und Vermutungen Einzelner gefühlte Wahrheiten, die mitunter auch halbwegs plausibel klangen. Der DDV und die gesamte Zertifikatebranche waren eigentlich ständig um Aufklärung bemüht, wohl wissend, dass es extrem schwierig ist, Fakten gegen Vorurteile zu setzen. Zu den damals gängigen Vorurteilen von Seiten des Anlegerschutzes oder auch von Journalisten gehörte die Behauptung, dass Zertifikate eine rein deutsche Besonderheit seien, Finanzprodukte, die es ansonsten nirgends gäbe und nur den merkwürdigen deutschen Anlegern verkauft werden würden. Das war damals schon grobschlächtig falsch und ist es auch geblieben. Allein schon aufgrund der Sinnhaftigkeit der Produkte für private Anleger, und das ist auch in anderen Ländern weitestgehend erkannt worden und wird honoriert. Allerdings glauben wir hierzulande gerne, dass wir immer, auch im Sinne der Regulierung, die Nase vorn haben. Das stimmt meistens auch, aber eben nicht immer. In Deutschland sind wir zumindest stolz darauf, dass wir seit Mai den IEV ausweisen. Hartmut Knöppel hat es gesagt, den Issue Estimated Value, also den vom Emittenten geschätzten Wert des Produkts. In den USA allerdings gibt es den IEV schon bedeutend länger. Insofern erscheint es also interessant zu erfahren, wie die Einführung verlief, was genau eigentlich ausgewiesen wird und wie die Aufsichtsbehörden diesen Prozess insgesamt begleitet haben. Antworten dazu kommen vom Head of America von Structured Retail Products, Joe Burris, der extra hier zu uns aus New York gekommen ist. Herzlich willkommen. Your turn.
Well, thank you very much, Lars, and thank you for inviting me here today. I just want to start with saying, as you've probably noticed, my presentation will be in English as well. I'm afraid on my 2 days here in Frankfurt, some of the phrases I learned this weekend on Schwazerstrasse during the football game are probably not relevant to this audience. Ein Bier bitte, I guess maybe later. I'll work on that one. I know I'm up against lunch, so I will try and make my comments as quickly as possible. If I do rattle on a little too much, please just give me the high sign and we'll head out to lunch. As Lars said, my name is Joe Burris. I'm the head of the Americas for StructuredRetailProducts.com. I don't know if you know much about our firm, but we are the only source for global data in the structured products market. We have a global presence with offices in New York and Hong Kong and headquartered in London. We're celebrating our 11th anniversary. And our databases cover over 8 million products currently. That's growing by the thousands per day, thanks to the German market particularly. The website includes term sheets, performance data, sales volumes, and a daily news service covering 41 dedicated markets. We work with the buy side, the sell side, index providers, law firms, regulators, many of the folks that are in this room or your firms. And they rely on our data for making daily business decisions. What I'd like to talk about today is size the market, both globally and in the U.S. We do have a retail structured products market in the U.S. I know some people this morning have been doubting me, but we do have that. So we'll be sizing that. I'll give you a heads up on year-to-date sales, both globally and in the U.S. Some sales trends that are not just U.S.-oriented. We're affected by the same global trends as you folks are here as well, to a differing extent. We'll talk about market trends and driving forces. I will share some data with you, so don't worry. I am not requiring you to write it all down. If you want some data or want a copy of our presentation, you can either email myself or my colleague Rihanna Farkari, who covers the German market at SRP, and she'd be happy to get you the presentation and possibly even a free trial to the website as well, as if you ask nicely. Looking at the size of the global structured products market, we count it as a little bit over $2.1 trillion US currently. This is retail only. It excludes institutional and private banking clients. It includes leverage and flow. If we were to include the institutional and private banking area, which is a little more murky for us to find that data, it would easily be 2 times this amount. But we count it again as 2.1 trillion globally, broken down by the 3 main regions: Americas, which includes US, Canada, and 3 markets, primary markets in Latin America: Mexico, Brazil, and Chile; Asia, and Europe. We count about $518 billion to mature in 2014. That's from over 1.1 million products. We see about 286 billion US maturing or rolling over in 2015 from over 407,000 products. So again, the pipeline is full on a global basis. To put that in comparison, latest count for hedge funds, according to our friends at Barclays Hedge at the end of second quarter 2014, they sized their hedge fund market at about $2.8 trillion, forgive me. So again, it is a sizable investment vehicle, structured products on a global scale. However, as we probably all know, global mutual fund assets are at several multiples higher, accounting about $30.8 trillion US dollars at the end of quarter 1. So to take more market share from mutual funds is obviously in all of our best interests. Incidentally, at latest count, ETF assets under management, which again are a very popular product being seen in the US, and I understand from my colleagues a trend that's developing quite strongly here in Europe as well. ETF fund assets are counted about 2.86 trillion, according to Vanguard at the end of the second quarter. So that's the global size of the market. Taking a look or drilling down into the US AUM, if you will, you see it's been growing fairly steadily since 2010. We count 308 billion US in our AUM number, and again, that's retail only. Again, if we were to count institutional and private banking, a little less transparent for us to find that number, but again, it would easily be a multiple of that. The wrappers primarily seen in retail world in the US are in the form of notes, registered notes primarily, deposits or CDs, and the insurance wrap products, so either equity indexed annuities or more broadly market indexed annuities. We count 30.5 billion in mature in 2014 from 7,200 products. I guess that 7,200 products is something you do in a day here in Germany, I think. No? Or maybe a slow day. 34 billion US to mature in 2015 from 6,250 products. And that's at the end of September of 2014. Some sales trends globally. We see the market possibly bottoming out globally at the end of 2013. We see an increase in sales year over year. We have both forecasted in the chart. We have forecasted full year numbers and year to date actual real numbers on that chart. It's a little confusing. And again, that's at the end of August 31, 2014. We see a good year for equities, has boosted sales globally for equity-linked products, led by strong sales growth in Asia, resilience in the Americas, and that seems to be making up for the slowdown or the offsetting losses in Europe. You see our year-over-year numbers. Some of the reasons cited for Asia's growth has been a reduction in bad press. The pricing environment for all is still rather difficult for principal protected products, as most of you know, and product simplification has really had its effect on profit margins, leading to a little bit more of a flow business or commoditized markets in many of these areas. In terms of our forecast for 2014, which was actually carried out at the end of 2013, our industry subscribers or our market players predicted about a 10% rise in the Americas to 74 billion US, a 7% rise in Europe, so a little bit optimistic there, and a 10% rise in Asia, so maybe not optimistic enough about Asia. So those are estimates made at the end of 2013. However, I will point out that Europe does remain the largest region with about 46% of global sales. Now, drilling down into the U.S. a little bit more, year-to-date 2014, we count about $34 billion in sales year-to-date. That is actually down a little over 6% year-over-year, as you see there. But we do forecast a small rise in the market, and that's seen in our fourth quarter and end of third quarter product pipeline, which hasn't bared out in the markets yet, in our final count yet. So again, we expect a small increase in the U.S. market for 2014. And obviously, in an environment, wait-and-see approach of monetary policy uncertainty and governments continuing to taper quantitative easing, we're fairly happy with that number. Again, it's bottoming out. More importantly, U.S. investors seem to be coming around, and maybe it's the environment of uncertainty, to the benefits of structured products. Again, we're a fairly new entrant into this market, and we think our efforts in terms of education and engaging with clients, regulators, and the full market is really starting to bear fruit. Incidentally, for year-to-date numbers, just in case that bar graph isn't very clear, we counted in 2010 a market of about $5.5 billion U.S., 2011 falling to about $53.6 billion. Again, these are tranche-based sales, retail tranche-based sales. So again, notes, deposits, the primary wrapper vehicle in the U.S. for retail. 2012, we counted $46.7 billion, 46.3, and currently 35.3 right now at the end of September 26. Market trends, again, I'll talk globally, but a lot of these trends and to different levels are seen in the U.S. We'll talk a little bit about the competitive environment, regulation, which I know is on everybody's minds, and I'll take briefly a minute to just continue to echo the case for structured products. First, in the U.S., I've given you a little breakdown by asset class and their market share in the U.S. retail. The importance here is in times of crisis or uncertainty, as issuers, being cross-asset is very, very important. Yes, the U.S. market is primarily equity-led. However, when different asset classes come into favor, as they did a few years ago with commodities, FX, and interest rates, now swinging to more equity-favored, it is important to have good, proper products in all of those asset classes. Less innovation in payoffs, so really the motor under the hood is becoming much more simpler. However, the innovation is really coming into where the product takes you or the underlying. That's certainly a global trend. Incidentally, I will point out that there's very much increasing interest in European underlyings outside Europe. In fact, we count about $3.5 billion of Euro Stoxx 50 exposure in the U.S. year-to-date. And if you were to just go back 1 year from now, the Euro Stoxx 50 wouldn't have even been on our top 10, broken down by underlyings. So a very interesting trend. And again, in some ways, the market's driven us there. Also, we have not seen much in the U.S. on multi-dealer platforms, which I understand is very big here in Germany and in Europe as well. And the U.S. has been really late to the game in development of e-distribution. We have them. All banks now have them, some better than others, some much, much better than others. But like the multi-dealer platforms, they were slow to evolve because, A, most of the sales in the U.S. for up until a couple of years ago were done through tied sales distribution. So if you look at market leaders, they'd say, well, I don't really need to spend this extra cost because the product's being sold very well and profitably through my sales force. And secondly, in terms of the multi-dealer platforms, we've really had another evolution, and that's really through the independent distributor, where they offer their other issuers' products to their clients on their own proprietary platform. So there's just a select number of their most favorable 2-3 offerings. That's more of an in-capital model, if you will, in the U.S. Prop indices, proprietary indices are not really ready to replace traditional benchmarks in the U.S. We're still a S&P 500 market at the end of the day. But there could be a place on the periphery in the private banks or the ultra-high net worth portion of the U.S. market. We see it growing of interest right now in those private banks and in the upper echelon of client-facing businesses at the big broker-dealers. In the U.S. thus far, though, we have seen quite a bit of pickup in products linked to volatility and dividend strategies. We've even seen a recent strategy tracking commodity futures. So again, these things are not industry-wide, but they are developing. And we expect them to develop even further. Level of capital protection, the U.S. investor has always been comfortable taking equity risk or taking principal risk. And it's not just this current pricing environment that's leading them there. In fact, the U.S. investor has really gotten their first taste of, back in 05, 06, with structured products through the reverse convertible, for good or bad. But right now, they're still the second most popular payoff style in the U.S. to retail investors. And just year to date, we count about $5 billion in sales linked to reverse convertibles. So again, what's come first? It's really been the investor attitude towards capital risk by the U.S. as opposed to the pricing environment. The competitive environment, I know this is certainly a global theme here. Market consolidation, you see the dramatic numbers in 2011 to 2012 down to 2013. We went from 70 active providers who actually issued a product in calendar year 2008 to just 29 who issued a product. It could have been just one issue, or it could have been 10 products, or it could have been 500 products. So just 29 players, and of that, the top 10 account for the majority in 2014. So no way about it, number of providers is reducing. I like to say that the largest market leaders in the U.S. are building their walls even higher and digging their moats even deeper to really insulate their business from outside competition. The top 10 issuers account for about 87% of the U.S. market. 53% of market sales come from the top top 5, so it is fairly top-heavy. And we have to ask ourselves, will less competition mean worse deal for investors? So something to be aware of, that we're facing in the U.S. as well as you guys here. Global M&A has had also a profound effect. I just really like this chart. That's why I'm showing it to you. But it echoes what we've seen in the last few years of just about the tremendous amount of M&A leading to consolidation. I imagine a lot of you in this room have called on and no longer call on some of these firms. So quite profound. Now we'll move on to, well, I can't switch right now. This is usually the part in my presentation when I enliven the audience with a request for market participation, but I can see from all the smiling faces that we're really hungry, so I'll spare you that. Let me just have one of you brave folks yell out what you think will have the biggest impact on sales for 2014 and foreseeable future for structured products. Anybody? Anybody? Yes, it is regulation. Thank you, Stefan. Excellent answer. Now, we're not against sensible regulation. In fact, if you ask any issuer in the U.S., we're actually think it's the most important driver or handbrake for growth. But sensible regulation will only serve to improve structured products and restore the faith in them and increase assets under management. It's really taking them from an investment banker's perspective to maybe migrating them to more of a longer-term asset manager's viewpoint, which is something we're wrestling with in the U.S. right now, doing that steadily and increasing that pace. The AUM numbers I showed hopefully bear this out, that this is a legitimate asset class that investors should consider for their portfolios. We feel, in speaking for the U.S., that the correct architecture is already in place. We're more concerned with the sales process at this point. The important thing now is to ensure that the right product is sold to the right client or the right correct category of client, and that the sales process is properly understood across the whole scheme, from issuance of product or manufacturer process to the person facing end user client. Otherwise, we all know what's going to happen and where the focus is going to be on when that breaks down, and that's on the banks. This slide just covers some of the challenges banks are now facing and have been and will for the foreseeable future. And that also brings me to estimated initial valuation. This was something that came to be back in the U.S. in the April of 2012 through the SEC's sweep letter, the infamous sweep letter of April 2012, we refer to it in the U.S. The Commission really addressed a number of issues with that sweep letter. I think it's very long, very deep, about 10 issues. Among them, one was the use of the term principal protection was frowned upon, but the one that got most attention of issuers and distributors, as you can imagine, was addressed estimated initial valuation. How was it calculated? Great question. I do not have a very good answer for you. What I will tell you is we got very little guidance from the SEC. However, they do view structured products as a compound security or having two parts. One part being the bond, the other the option or the derivative embedded in that product. And it was really disclosure higher, emphasize the disclosure as opposed to the actual execution or mechanics of the product pricing or valuation. All they said was that the bond should be valued using the issuer's funding rate or credit spread, and that any models or assumptions used on the price of the option should simply be disclosed. So again, they gave a lot of leeway to the issuer. The impact, well, if you ask any of the issuers, the impact, increased transparency, the canned phrase is increased transparency, always a good thing, is what you would hear. However, now that this has kind of made its way through the market as a non-issue, and I hope your experience with estimated initial valuation is as successful that it can become a non-issue. Where it has had some issue is really on the distributor side, because as you all know, structured products, for the most part in the US, take a little bit of technical knowledge on the part of the sales force. It's not a simple tracker. You don't look it up. By the way, structured products in the US are primarily not exchange traded. So it takes some technical knowledge and some understanding and client relationship skills to explain these products to retail investors in the US. And a lot of the distributors weren't comfortable giving this type of ammunition to their sales force at first. However, we found two things. First, it seems the U.S. investor continues not to read the prospectus even though it's in their best interest, because they didn't really have any questions regarding estimated initial valuation. And secondly, the feedback was when they did realize and read the prospectus and understand what the estimated initial valuation was, their response was, that's all you're taking out. They were kind of surprised that that's how small the discount was. So again, against comparative products in the U.S., structured products, I guess, on an initial estimated valuation were quite competitive. We've even seen issuers take it even further. We can stay with this just to give you evidence that we are doing it, but some issuers have even taken it a bit further and have started including estimated initial valuation on their deposits or their CD wrappers, which, as you probably may or may not know, in the U.S. are not regulated via the SEC. They're a bank deposit and regulated other ways. But they've thought enough about including it for their clients' transparency to include it. I'm not here to sell you or to single out any one particular issuer. It's just that over my last couple of months in Europe, primarily when I've talked about this, people still doubt that we do this in the U.S. So I just pulled this out to prove to you that, yes, it is up there. It's on the front page of the prospectus. Some rhetorical regulation, please. We're not going to discuss this because of timings, but if you are issuing products, I don't care if it's in Frankfurt, London, or the US, these are probably some questions you want to ask yourself about your current issuance or future issuances. So what are we to do? What helps you do your job as an issuer is really three things. Both sides, regulators and issuers and players in the market, bankers, whomever they may be, need to do your jobs and put clients and investors first. Better communication. I can't echo enough how much I would love to see an event like this in the U.S. and how helpful that would be to the market. And engagement from all parties is just wonderful. And less intervention, In the US, the German market is held up to be the most transparent, most innovative, most ahead of the curve, if you will, market out there. So I thought I'd just pass that along to you, that you guys are maybe the example of where the US market wants to get. We do have a US Structured Products Association. It is somewhat of a part-time job of the person running it. It's a grassroots campaign. The business is funded, or the organization is principally funded through events. There is no bank participation per se. It's the individuals who participate. So again, we're a long way off from the ideal in the US. So the case for structured products. Just like to share with you some anecdotal data from a street poll. Well, I already covered the sales forecast. And then just reiterate some of the key challenges for all of us in this global structured product market. So first, a little bit on US investors and their mentality or their appetite or their knowledge base. Back in June of 2014, we sent our esteemed research staff out into the streets of New York City and asked them to question some common folks walking around in the Bryant Park area of New York, a lovely area, and expecting the New Yorker to be a little bit more innovative in their thinking about financial products, a little more advanced. We asked them a simple question. First, do you know what a structured product is? And 21 out of, it was roughly about 100 people, so 21 people said yes, they do. Of those who said yes, we asked, do you think they are a good thing? And the overwhelming majority, 83%, said yes. Very, very surprising. And of those 83, if yes, do you invest in structured products? And we had more than half. So that leads me to think if we continue to do a better job in educating and getting the word out on structured products, we might be able to grow this thing. The comparative in Europe, we did it in London. Again, probably a higher level of investor walking the streets of London. 32% of the respondents knew what structured products were, but only 21% of them said they would invest. So again, maybe a little more work to be done over there. But again, very optimistic. We're not done there. We also asked them, the US investor, the New Yorker, do you know what a mutual fund is? And again, I'm very happy of my fellow Americans that 65% of them knew what a mutual fund was. Do you know what a hedge fund is? And actually 61% knew what a hedge fund was. And then when we moved to ETFs with all their million-dollar marketing campaigns, we asked them, what is an ETF? And only 16% of the folks queried in New York City knew what an ETF was. That's amazing that fewer people knew of an ETF than what a structured products was. So maybe they're spending their money a little less efficiently. Where does the average U.S. investor invest? Structured products came into that other 7% category, but you can see, unfortunately, 21% were via savings accounts. So that's 21% of dead money at this time. Bonds, 17%. Shares, which I understand from colleagues here that share count is fairly high for a retail investor. But again, it's the equity culture in the U.S. So I thought that would be of interest to point out. The case for structured products, again, you're all professionals. I don't need to point this out. I'm not a cheerleader for structured products, but just to remind some of you that may not be structured products people in the audience, that structured products have proven themselves and they deserve to be in an advisor's toolkit or toolbox. But we do have some significant challenges as an industry that are not just in the U.S. but globally, and for many of you in this room. So we need to ensure appropriate products are sold. Short-term gain, as we all know, leads to long-term pain. We need to deal successfully with regulators and their proposals. Talk to the enemy, if you will. Engage, they don't bite, as this fellow gentleman was so kind earlier. Be cross-asset. Educate retail investors. 79% of people don't even know what a structured product is in the U.S. 68%, excuse me, globally, 68% in Europe. Of course, common business practices 101, improve client service, deliver exceptional investment returns. And then just leave you with, right now, some questions, if anybody has any. Yes, sir.
It's the regulator.
Yes.
I saw in your numbers, your figures, that there was a big fall in issuers in 2012, and that was in the same year the sweeping letter of the SEC flew around through the markets. Is there any causality there? Is that a regulatory action that scared you from the markets, or is it just a coincidence?
No, absolutely. The letter probably had somewhat of an effect, but it was mostly seen. It was also RBS leaving the U.S. market as well. That had a. But we always had these, they were mostly foreign players in the U.S. that would only offer a handful of products that were only, I don't want to use the term dabbling in the market, but they were. They didn't commit enough assets or capital, and that was just the final straw that broke their back, and they said, you know what, this increased cost and regulatory costs are just not profitable for us to stay in this market, and they've left. I will caution you, though, they didn't leave for good forever. Some have even started to come back, and you saw that pick up in last year. So that was what I would say is partially responsible. Yes. Anyone else? Perfect clarity? Well, thank you very much for your time, ladies and gentlemen.
Thank you very much.